Hello, and welcome to this week's edition of the Echo45 Advisors Market and Economic Update. My name is James Sutton, Director of Portfolio Management and Technology, and I'm filling in for John this week. In this video, we'll discuss the current market environment, where stocks have climbed to new all-time highs and bond yields remain near multi-decade highs. At first glance, it might seem contradictory for stocks and interest rates to be elevated at the same time. But as we'll explore, there are good reasons why both asset classes can perform well together, and what that means for long-term investors. Over the next few minutes, we'll walk through what's driving the stock market rally, why trying to time the market often backfires, and why bond yields are creating some of the best bond opportunities we've seen in years. First, let's look at what's been driving stocks higher. The S&P 500, NASDAQ, and Dow Jones Industrial Average have all generated double-digit total returns this year. Technology stocks have been a big part of the story, fueled by continued momentum in artificial intelligence. Energy has also contributed, supported by higher oil prices. But there's a driver beneath the headlines, which is interest rates. Rates can rise for different reasons. When they rise due to inflation fears, that tends to weigh on both stocks and bonds, as we saw in 2022. But when rates rise because the economic outlook is improving, that's a different story. Stronger growth expectations can actually support stock valuations through better earnings, while also giving bond investors more attractive yields. That appears to be what's happening today. With markets near all-time highs, a common question is whether investors should wait before getting invested. It's a natural instinct, but history suggests it often works against investors. As this chart shows, an investor waiting for just a 5% dip before putting money to work would have waited an average of 303 days. And during that waiting period, the market would have already gained nearly 14% on average. Because markets tend to rise over time, the next dip is often higher than the last one. This doesn't mean that markets only go up or that volatility won't happen. It simply means that new all-time highs are a normal part of bull markets, not a warning sign on their own. Finally, let's talk about bonds. While stocks have had a strong year, bonds have been flat due to rising rates. Bond prices move in the opposite direction of yields, so when rates go up, existing bond prices come down. That's the short-term challenge. But the other side of that story is that higher yields mean investors can now reinvest at much more attractive income levels than we've seen in decades. As this chart shows, the starting yield on a bond is one of the most important drivers of its long-run return. Investment-grade corporate bonds and treasury securities are now offering income levels that were simply hard to find over the past 2 decades. For long-term investors, this creates meaningful opportunities in fixed income that haven't existed for quite some time. We hope you found these insights helpful. If you would like to discuss the stock market, bond yields, or your overall portfolio strategy in more detail, please don't hesitate to reach out to us. We look forward to speaking with you soon. Have a great week.